December 11th, 2024. A metal that most people ignore just triggered the largest institutional panic in precious metals markets since 1980. While everyone obsessed over Bitcoin and gold, something extraordinary happened in silver that changes everything. The Royal Canadian Mint went dark, out of stock across all silver products. The Perth Mint halted production entirely. Indian dealers defaulted on contracts they'd held for decades. And in London, the global epicenter of precious metals trading, lease rates exploded to 39% annualized. That's panic pricing you haven't seen in generations. But here's what makes this different from every shortage you've heard about before. This isn't just supply and demand. This is the controlled demolition of a market that three powerful forces have been manipulating for over 15 years. China just announced export restrictions starting January 1st, 2026. JPMorgan Chase, fresh off a $920 million market manipulation fine, controls 43% of all silver inventory in the exchange system. And industrial demand has reached levels that make substitution mathematically impossible. By the end of this investigation, you'll understand exactly why $75 per ounce isn't just a price target. It's the trigger point where this entire system breaks permanently. And when it breaks, the people holding physical metal won't just profit. They'll own the only asset that matters when paper promises become worthless. Three-stage pattern playing out right now. Stage 1, market control through paper manipulation. For 8 years, JPMorgan placed hundreds of thousands of fake orders to suppress silver prices while accumulating physical metal at the artificially low prices they created. Stage 2, inventory depletion. COMEX registered silver has dropped 81% in less than 2 years, from 47 million ounces to just 8.9 million today. Stage 3, the squeeze. Industrial users are panic buying, governments are stockpiling, and the paper market is running out of physical backing. China's role makes this crisis unprecedented. As the world's second largest silver producer, controlling 60 to 70% of global output, their export restrictions will cut available supply by over 2,500 tons annually. That's not a temporary disruption, that's a permanent shift that removes the buffer keeping paper markets functional. China produces 80% of global solar panels, and every panel requires silver that cannot be substituted without massive efficiency losses. Screenshot these 7 critical numbers. COMEX registered 8.9 million ounces. JPMorgan 196 million ounces direct plus 517 million ETF control. China 60-70% global output. Lease rates 39% annualized. Solar demand 197.6 million ounces. Total demand 1.16 billion ounces. Basel III. Physical backing now required. The mathematics are brutal and undeniable. Total global silver demand reached 1.16 billion ounces in 2024. Industrial consumption alone hit 642 million ounces, with solar panels consuming a record 197.6 million ounces as new high-efficiency panels require 40% more silver per unit. Mine production peaked in 2015 and has declined since. Recycling recovers less than 20% of consumed silver. The deficit grows every year while available inventory shrinks. Timeline accelerating beyond control. COMEX registered inventory dropped 4.1 million ounces in November alone as metal flowed to Shanghai. At current depletion rates, mathematical exhaustion hits in 12 to 16 weeks. China ban activates January 1st. At $75, 3 thresholds converge simultaneously. Mining companies stop feeding COMEX, Asian arbitrage drains Western inventory, industrial procurement shifts to panic buying. This isn't 1980 when the Hunt brothers could be bankrupted by rule changes. This is systemic failure across interconnected global supply chains, where silver substitution remains impossible and demand growth appears unstoppable. Solar demand alone could consume 98% of known reserves by 2050, according to University of New South Wales. But 2050 is irrelevant when crisis hits 2025. JPMorgan's position reveals the trap they've engineered for themselves. That $920 million spoofing fine wasn't the end of manipulation. It was evidence of strategy. They now hold 713 million ounces under direct influence. But Basel III requires physical backing for paper positions. When silver crosses $75, delivery demands they cannot satisfy expose the fractional reserve fraud. The evidence is undeniable. The data is public. Three powerful forces have converged. China's export restrictions eliminate supply buffer, JPMorgan's scheme collapses under regulation, industrial demand makes substitution impossible. At $75 per ounce, this is the mathematical endpoint where 15 years of manipulation meets physical reality. When this system breaks, and it will, the institutions holding paper contracts discover they own worthless promises, governments scramble for reserves they should have accumulated years ago, industrial supply chains face cascading disruptions. But those who recognized this pattern early understood the mathematics before the crowd. Positioned in physical metal, they won't just survive, they'll own the asset that maintains value when paper systems fail. The clock counts down, inventory depletes, mathematics scream. Question isn't whether crisis hits. Question is whether you'll hold paper promises or physical metal when it does.